Hi, ladies and gentlemen, this is Game of Trades, and this is going to be a deep analysis of the S&P 500. The stock market is going parabolic. We are seeing huge gains in the S&P 500. You can see right here with several huge green candles on the monthly chart, especially leading into this end of 2019 with the Santa Claus rally. Now, to me, this is not healthy. This is not normal price action. This is what looks like bubble price action. After 10 years of a strong bull market since 2009, it is unhealthy to see this type of parabolic price action. Retail investors are pouring in at the top of the bull market, and it's frankly almost hard to watch. And now that brings me to the point of the video, is the economic expansion that we've seen since 2009 over, and are we heading into a potential recession in the coming years? And to really analyze that, we're going to take a look at a market cycle template that I'm going to put on the screen right now. So this is what a typical market cycle looks like with the bull market and the bear market you can see right here. There is something to remember about this, and that this is natural. This is a natural, normal phenomenon in the economy, and it does not mean there's anything wrong with the economy fundamentally, and it will happen whether we like it or not. Another interesting thing to know about this is that it happens every 10 years or so, and that is extremely interesting considering the time frame of our current bull market that began in around 2009, 11 years ago. Now I'm going to go back to the S&P 500 and we're going to compare the two. And I'm going to put the market cycle template on the corner of the video so that you can see as I go along and compare the two and make predictions into the potential follow-up of this bull market. Now, this video did take some time to prepare, so don't hesitate to drop a like on this video. It really does help me out a lot. So let's get right into it. So this is the first part of the chart. This is the takeoff. It typically is slow, and it was right after the 2008 crash. So it is normal that people were skeptical right after this. It is a typical slow takeoff of a bull market and leading up right until 2015. And now this is where things get interesting. We did see a temporary top in the markets in 2015 and a quite significant drop right here, and that would correspond to the bear trap you see on the market cycle template. This was around from top to bottom, a 15% drop, and I can tell you for a fact that people were expecting more of a drop at the time. The typical bears of the stock market were expecting a drop back down to backtest the highs of 2008, and this did most likely squeeze many shorts and gave the stock market the fuel to actually continue the bull market. I'm going to draw that up. So it's starting to look very similar to the template, and it leads us actually to our next phase, which is the enthusiasm phase. This was exactly what that was. This was the Trump rally right when it got elected. He was promising tax reforms that would most likely boost the economy in the short term, and that is exactly what happened. We had the Trump run, and we did get ahead of ourselves and had two significant drops in the stock market, which really should have been huge warning signs for investors. These drops were accompanied with an MACD bearish divergence. And if you don't know what that is, the MACD is a momentum indicator that many traders use, many fundamental analysts use in their trading when predicting stock market, bull markets, and bear markets. A bearish crossover doesn't get any more bearish than that. So a significant drop after a long bull market with a bearish MACD crossover in all logic should have been the top to our bull market, and that's what many people thought at the time. But no, the market cycle does have a final phase, and that is greed. And if this last move in the bull market is not greed, then I don't know what is. A significant drop being bought up with a 40% plus move up within a year, despite a bearish MACD crossover at the end of a 10-year bull market run, is the definition of greed. Now you may be thinking, all right, that's nice, but what's next? Where are we going to go with this? And that's where I want to draw a simple trend line that represents this bull market that we've seen since 2009. And this trend line would go from the bottom in 2009, have a reaction in 2011, one in 2016 after this bear trap, and a last reaction here in 2019 very recently. So if this trend line represents the bull market, then obviously if this is the end of the bull market, we would need to break this trend line for the next phase of the bull market to begin. And this would look something like this. We would probably continue the greed phase all the way to around $3,500 on the S&P 500. We would then descend all the way back down to the trend line and bounce off of it. This would be the bull trap you see on the template, and we would then proceed to break it down again and drop down to the next support level right here, back to the 2015 support level. And this is why having consolidations during a bull market is actually important, because you create these support levels that you can safely return to in times of trouble. This is a nice support level that we created in this bear trap in 2015, 2016. And what is very interesting about this level is that if you draw a Fibonacci retracement level from the bottom in 2009 all the way to the potential top at $3,500, this would actually coincide precisely with the 50% retracement level right at the support level. So this would really be an extremely realistic support level to come back to in case of a recession. Now, the last thing I do want to address in this video is the return to mean. You can see there is a dotted line on the market cycle template picture right there. To explain this, I'm going to go and put the chart in logarithmic mode, and that would actually put all these moves in equal proportion. So this trend line is no longer valid. I'm going to delete it right there, and we're going to go back all the way to 1970 right here. And from 1974, we can see there is a low right here. And you're probably thinking, seeing this, that this is a huge bull market and that this was longer than 10 years of bull market. But one thing to consider is that this is coming on the heels of a 20-year, a 2-decade period in the US where the stock market was in horrible conditions all the way to 1974. So the S&P 500 did have some catching up to do leading up to the 2000 dot-com bubble. Now back to my point, I'm going to draw a nice trend line that would actually correspond to the dotted line on the market template. And you can see we have a reaction in 1974, one in 1982, and one in 2009, and one last one in 2024 right here, right at the end of the 2020 to 2024 bear market. Now obviously all of this is hypothetical, but it does seem very likely and very plausible. So I hope that you watched this video till the end and that this fascinates you just as much as it does to me, because I love these kind of coincidences and really plausible predictions in the stock market. I hope you guys enjoyed this video. Make sure to like and subscribe if you did. It did take a lot of time to prepare this video. In the meantime, good luck on your trading and see you next time.